Bitcoin is not going along with the tech ride. Since March 17th, about that time, where the NASDAQ is up better than 10%, Bitcoin is flat. As the Fed is hiking rates in order to fight inflation, that is putting downward pressure on the value of these lower yielding longer term instruments. So this is something that those, ignorant fools at the FOMC were oblivious to because they didn't understand economics.
Peter Schiff, the eminent economist and global strategist at Euro-Pacific Capital, has drawn attention to the remarkable inverse price fluctuations witnessed in gold stocks and Bitcoin. Last week, the gold market experienced a substantial decline, with prices plunging below the $2,000 per ounce threshold. This significant sell-off was primarily triggered by the stern rhetoric of numerous Federal Reserve officials, coupled with a growing anticipation of an imminent interest rate hike in June. According to Peter, gold may be a better choice for those seeking a stable, long-term investment, while Bitcoin may be more suitable for those looking for a high-risk, high-reward investment opportunity. In his tweet, he said, "The reason investors are buying tech stocks instead of gold stocks is that they expect the Fed to begin its next easing cycle soon, but they also expect CPI-measured #inflation to keep coming down. When they are surprised by a rising CPI, they'll sell tech and buy gold stocks."
Bitcoin is not going along with the tech ride. Since March 17th, about that time, where the NASDAQ is up better than 10%, Bitcoin is flat. Bitcoin hasn't gained at all. In fact, it's lagging behind the ARK ETF. There used to be a very strong correlation between Bitcoin and the ARK, innovation ETF, and that is broken down. I mean, Bitcoin isn't correlated to any tech anymore because it's just kind of flat-lined as all this tech is going up. Now, I know a lot of people in the Bitcoin community are saying, well, that's because it's now correlated with gold, right? Because gold has kind of been flat for the past couple of months. In fact, gold is only about 1% above its January peak. And by the way, to show you where the sentiment is, the GDX gold stocks today closed 4% below the January peak. And the juniors, the GDXJ, they're 8% below their January peak. So even though gold has gone up a 1% higher than its high water mark in January, the junior gold mining stocks are 8% down from where they were when gold was 1% lower. So that shows you the investors' mentality. In fact, investors are selling gold stocks, or they probably don't even own them, so they can't really sell them. Maybe they're shorting them, and they're buying tech stocks. But why are they doing this? What is the driving force behind this? And in fact, before I get into it, though, just to make one point on Bitcoin before I move away from this topic, I think the fact that Bitcoin is no longer moving up with these spec names, that is a bad sign. It is not a good sign that, well, now finally it's digital gold and it's correlated to gold. I don't necessarily know that logic is going to flow. What may in fact happen is that when gold finally breaks out of this range and gold stocks break out, maybe Bitcoin won't follow gold either. And if it's not going to follow tech higher and it's not going to follow gold higher, then what's it going to do? Well, it's just going to drop, because I know it's not digital gold. It was reinvented as some type of highly volatile, correlated asset to risk on. But if it's no longer correlated to tech, and if it's not correlated to gold, then it's correlated to nothing, and it's just going to go down because there is no reason to buy it.
Schiff asserts that the industries dependent on artificially low interest rates are currently experiencing a gradual disintegration as their foundation proves to be fragile. According to Schiff, the Fed is losing its fight with inflation. That's why it's going to try harder. But it's going to be ineffective. If they couldn't beat inflation with 5%, they're not going to beat it with 5.25%. As of Friday morning, market pricing data from the CME Group reveals a probability of approximately 35% for the Fed's potential approval of another interest rate hike during its upcoming June meeting. Current data suggests a robust economy and labor market, along with inflation levels that, despite declining from their peak in 2022, remain significantly above the Federal Reserve's target of 2%. In a tweet, Peter said, "No one should be excited about April CPI rising just 4.9% versus expectations of a 5% gain. 4.9% is still well above the Fed's 2% target and likely represents trough #inflation. Also, April's 4% rise in consumer prices is much
What
hotter
I
than the
think is
1% rise the
driving
prior month."
the move into tech, apart from AI, which is just part of the theme, is the belief that the Fed is either done hiking or close enough to being done that the traders can now see the whites of the eyes of the first rate cut. And that's what the markets are doing. They are looking beyond the rate hike, whether we have a rate hike in June or not, and whether or not there's another quarter point hike. I mean, either we've topped out now at 5 to 5.25, or maybe the markets think another 50 basis points max, 25 basis points maybe, and then that's it. So we're 90% of the way done with the tightening. And there's just this little bit left before we get relief, before we get more of the drug in form of rate cuts or expanded QE. And the tech stocks, the tech investors are anticipating that the next round of monetary easing will be just as good for tech as QE1 or QE2, 3, or 4. Everybody expects more of the same. And one of the reasons is because they expect the inflation rate to come way down. And so they expect us to return to the same Goldilocks environment that the tech stocks were operating under for the past decade or more, which is an accommodating Fed with cheap money, low interest rates, all in an environment where inflation is perceived to be below 2%. That is the sweet spot. That's what these high multiple stocks need to justify the valuations and to continue the flows that are necessary to keep these stocks going up, because it's not the earnings that are going to power them. It's not the dividends that are going to power them. It's going to be the momentum of money chasing them, which is a byproduct of the monetary policy. Well, I think they're wrong. I think that they're right in sensing that the Fed is getting close to the end of this cycle, although they're wrong in their belief that the Fed is going to be able to complete another easing cycle. See, I think that even if we peak at 5 to 5.5, that after the Fed starts cutting, they're not getting down to 0. They're not even getting to 1. They probably won't even get to 2, because at some point, inflation is going to be running so hot that they're going to have to do an about face. They're going to have to start hiking rates. And that's what the markets are getting wrong. That's what the bond market is getting wrong. They're right about sensing the recession, but they're wrong in assuming that recession means a return to 2% inflation. It doesn't. The next recession is actually going to be a catalyst for a dollar crisis and a resurgent in consumer prices. So inflation, as measured by the CPI, is going to be headed higher as the economy and markets are headed lower. And that is the outcome for which nobody is prepared, including the Federal Reserve.
Traders are still tiptoeing around markets as multiple risk events remain at the forefront, but Bitcoin margin and futures markets are starting to favor a bullish breakout. Bitcoin has been trying to break above the $27,500 resistance for the past week, but to no avail. Two assets that are in focus for today are gold and Bitcoin. The latter serves as an alternative store of value amid collapsing regional banks in the U.S. What do you think the future holds for Bitcoin and gold in terms of price and value? To wrap up our discussion today, we invite you to leave your thoughts in the comments section. If you found this content useful, please show your support by giving it a thumbs up and subscribing to our channel for the latest news and videos. Thanks for joining us.